Year-end is in sight and investors are switching to a lower gear, protecting their P&L against turbulence. Volatility has been a common occurrence in 2011, in particular with sovereigns. So which sovereigns then would offer investors better protection against short-term volatility? We have compared the CDS spreads for about 50 sovereigns, ranking those by the absolute level of their spreads, but also, more importantly, by their CDS volatility. In fact, low CDS volatility should also imply low volatility of the underlying instruments. And we have found some interesting surprises, particularly among top names. First of all, we have ranked all sovereign CDS by their absolute levels. At the bottom, predictably, we find Greece, Ireland and Portugal. In Latin America, Venezuela and Argentina, and in Eastern Europe, Ukraine. But apart those extreme cases, all above 500 basis points, among the most expensive CDS spreads we find Italy, Vietnam, Croatia and Hungary, whose CDS range between 440 and 510 basis points. Of those, Italy presents the highest volatility, with a standard deviation of 67.8% over the last 50 days. The least expensive CDS are on US, Canada and Switzerland, with a strong Nordic presence of Norway and Sweden. For the record, it's worth mentioning that Finland ranks 6th. A low CDS spread is a factor of comfort, but volatility of the underlying assets is even more important, particularly over year-end. So we have taken the standard deviation of CDS over a 50-day period, and we have found no surprises among the highest volatile sovereigns. But we have found some unexpected entries at the top. Starting from the 10th least volatile CDS, we find Switzerland, despite recent currency volatility. Australia and New Zealand have a comfortable volatility of about 11%, while Finland is the only Eurozone country in the first 10. In 6th place, interestingly, we find Qatar, whose public debt is only $17 million. So such a small amount of debt is unable to accommodate new investors, but CDS volatility may encourage Qatari issuers to come to the market. In 5th and 4th place, we find Sweden and Norway, both unscathed by the Eurozone crisis. A strong vote of confidence for the UK, whose CDS has been only 6% volatile. In 2nd place, despite the debt limit debate, the US, whose status of risk-free asset is still undisputed. And finally, in 1st place, Canada, with a mere 2.2% volatility, well deserved for the combined discipline showed in public finances and banking supervision. In conclusion, North American, UK and Scandinavian sovereigns would cope well with market shocks and assure bond investors a safe crossing over year-end. I am Vincenzo Albano, and this is Reuters.